Hey folks, welcome back to the channel where we try to make sense of what's happening in the markets. This week is midterm elections, so let's take a look at how elections affect the stock market and what we can expect with stock performance going forward. If you're wondering why the US stock market is down so much this year, according to RBC Wealth Management, the S&P 500 tends to underperform during midterm election years, which is this year. On average, you only get a gain of 5.8%, and then the median return is 6.2%. This is likely because the midterm elections are near the end of the year, and the stock market doesn't like uncertainty. So before elections, some investors may be afraid to go long. But look what happens in the year after midterm elections. You typically have a really strong year with the average return being 16.3% and the median return even higher at 18.1%. And this is using data going back to 1932. To corroborate this finding, we also have Forbes giving us all the one-year returns after a midterm election, going all the way back to 1950. And you can see it's never been negative. The average one-year return after a midterm election is 18.6%, whereas in all other years, it's been 10.6. So the year after a midterm election historically has been a very good time to buy stocks. The last time after the 2018 midterm election, the stock market returned 14%. And if you see historically, you often get even higher returns, with the lowest being 4 back in 1986. So that would have been the return in 1987, which I believe was the year of Black Monday, where the stock market just dropped like over 20% in a single day. Here's another chart from HBKS showing the average return of all other years represented with this black line and midterm election years, which is this year in this blue line. As you can see, it's not unusual to see the stock market fall in a midterm election year. In fact, you would expect it to from the beginning of the year to October, it looks like. However, in November and December, you kind of have this Santa Claus rally that's very bullish going all the way to the end of the year. So if historically stock markets picked up right around now in early November, is now a good time to buy the stock market? Well, not quite, and I'm going to explain why. I think it's a little bit too early just because of what the Federal Reserve is doing right now, but you also don't want to wait too long. So I'm going to give you my take on when is the best time to put money into the market over the next year or so. But first, let's take a look at how common it is for the stock market to fall in an election year. The average drawdown of the S&P 500 in an election year is about 20%, and I think the S&P 500 is down about 25%, so we're not that far off from historical averages. But look at the return from the bottom to the highs of the next year. So this is the opportunity I think that investors have basically from now until the end of 2023. And that's only if you're able to time the market perfectly, which I don't expect anybody to do, but you can dollar cost average into the markets, and I would do it before the end of the first quarter next year. So now let's talk about the best time frame to put our money to work. There are three things to keep in mind. The first is inflation numbers, and we're getting the next CPI release later this week. And this is really important because last time it was a miss and the stock market fell a lot. And by miss, I mean the inflation numbers came in hotter than expected. So this week, for the headline inflation number, economists are expecting 7.9%, and then for core CPI, 6.5%. The numbers in this column on the right here 8.2 and 6.6 are from the previous month. So we should see the trend coming down. Now, if inflation comes in hot again, just like before, and we get like 8.0 or 6.6, in other words, it didn't change, or it's even higher, then expect a very red day on Thursday, November 10th. So I would wait until at least after this week to think about putting money into the market. The second thing to consider is when the Federal Reserve will stop raising interest rates. And right now, according to investment analyst Jim Bianco, we're looking at May of next year is when the terminal Fed funds rate will be reached. And that terminal rate right now is at 5.1%. When the terminal rate will be reached fluctuates, as you can see with this bottom chart, but usually between, it looks like February to July of next year, they're likely going to slow down the rate hikes until they get to zero. Jim put out this other graph here. It's a little bit dated, but you can see the overall curve. And we'll just use the yellow line here as the most recent number here. And basically, I would be hesitant to invest until I see a slowing down of rate hikes. So maybe in like December if they do like a 50 or even a 25, then that would be the signal that the Federal Reserve is starting to turn their monetary policy more dovish. And historically, when interest rates start to come down, which right now looks like it's going to be, again, May of next year, then that's when stock markets will start to rise again. Now, because everybody knows that from history, there are going to be some investors who want to get in front of that. So maybe they'll start to invest in March or April of next year before the stock market really takes off. But there is something that can change all of this and actually push the timeline to the left so that we can actually see a U-turn sooner rather than later. And that is the third thing we have to pay attention to, which is non-farm payroll numbers. This is basically the total non-farm employment of everyone in the United States who are working. And typically it does go up, but sometimes you do see pullbacks where the number goes down, and that's usually followed by a recession, which are these gray bars. So we have employment increasing, and then layoffs, and then recession, and then employment comes back, more hiring, and then huge layoffs, and then a recession. And then this last one here was in 2020, and now we're over here. So it doesn't look like we are heading down yet, but remember that it can drop pretty fast to help us gauge when the next period of mass layoffs will be. We can take a look at the Conference Board's Leading Economic Index, LEI. And this index basically tracks the business cycle and tends to be 6 or 7 months ahead of current economic conditions. So Bloomberg actually has a graph where they overlaid the Conference Board's leading index in blue here with the non-farm payrolls year-over-year growth. Because the leading index, the blue line, tends to lead about half a year before the economy turns, what they've done is just push forward that index by 6 months on this chart so that it lines up better with the payroll numbers. And what we can basically see is when the leading index, when the blue line hits this -10 range down here, it coincides with a massive drop in payroll numbers. In other words, big layoffs. Over here as well, blue line coming down to -10%, and then massive drop in employment. The great financial crisis was a big one. The leading indicator dropped all the way to -20%, and the non-farm payrolls year-over-year change was -5%. And then in 2020, it's literally off the charts, even though the leading indicator wasn't down too much, just down about 10%. But of course, a lot of people, especially in the hospitality industry, got laid off. So you had a very negative year-over-year number for payrolls. And now let's take a look at what is happening over here in 2022. So that's going to be somewhere over here. The leading indicator has now crossed below the 0 line. Will it fall to -10? I don't know. It looks like it's definitely going towards -5. And in the past, when it got to -5, we saw the non-farm payroll numbers also head down below 0. So because we're seeing this really sharp drop in the blue line with the leading indicator, I do expect this black line, non-farm payrolls, to drop very quickly as well. In fact, Bloomberg is saying that the payroll growth is headed to 0 in coming months. So that's not in like a year from now. That's like in December or January or February. So looking at the leading indicator, this kind of suggests that perhaps if we have massive layoffs and payroll numbers fall very quickly, then instead of the Federal Reserve pausing interest rate hikes in May, they might pull it back to April or even March. And if that were the case, then I think January and February would probably be the last opportunity to get into the market to take advantage of that bull run, most likely coming in the next year. So looking at the S&P 500, this is the daily chart here. So each bar represents a day. What I would do is start dollar cost averaging from the middle of November. So basically next week, let's say November 14th. And I would continue investing until maybe the middle of March or the beginning of March, somewhere around here. So if I had like $300, I would invest $100 at the beginning here, and then a third of the way through, and then I'd be fully invested by March. Now, a few things can change this. If we get a really bad CPI reading and it just doesn't look like inflation is going down, then the Fed funds rate may even go higher than the current 5.1% terminal rate. So if this gets revised to like 5.2, 5.3, which there's a real possibility of, because as you can see from earlier this year, we've just been basically on an uptrend. So if that keeps going higher, then the stock market will probably continue to go lower, which is why if this week's CPI number is bad, I'm actually going to wait until the next month's CPI data. And that might mean that I'm going to wait until December to go in, because it's better to get in a little bit late on the way up than to get in too early on the way down, because look how choppy the stock market has been over the last month, and especially over the last 2 months. I don't think the stock market will turn around until the Fed at least starts to change direction, and they won't change direction until we see noticeably lower CPI numbers, which hasn't been the case for the past 2 months. So even though the year after midterm election is really good for the stock market, it doesn't mean it's going to start being good right away, especially with the current macro situation we have right now. In terms of the end of this dollar cost averaging range, I might bring this in so that it's like closer to the beginning of February, depending on employment data. Right now, payroll is still looking really good. If I go to a 5-year chart, we can see that since 2020, more and more people have been getting employed. However, it's starting to roll over now. You can see that the angle of the slope is now more flat compared to last year this time. And it's especially flat when compared to 2 years ago, where the economy was just recovering from the last recession. But notice how fast this can change. In February 2020, payroll numbers ticked up, but the following month, there was no warning. It was just a complete drop that wiped out the previous 3 months of payroll increases. And then the next month was, of course, even worse. So at any time, this is October now, the most recent data, if we get November, December, at any time, if we see any weakness, like a drop like that, or even just a flat line, then that would be a signal to watch what the Fed is doing, because there's going to be a chance that instead of the curve looking like this, it could look more like this, which means not only is the terminal rate going to be lower, but also we don't have to wait until May or April, because if that was the case, then we would see the peak of the Fed funds rate being reached in February instead of later. So in this type of situation, I would put in $100 over here and $100 in the middle here, and then the last 100 over here if I had $300 to invest in the market, for example. What I'm not going to do is wait until like July or even the fall of next year, because by then most of the returns I think will have already been priced into the market. It's kind of a balance, right? I want to invest my money before the majority of the recovery takes place, but I don't want to preemptively invest when the market is still going down. Because right now, if we take a look at where the stock market is going, it looks like we could still head lower. And I think a lot of that is going to depend on the inflation numbers that come out. Now, what about the results of the election? I'm just going to briefly go over that, because which party runs the government does seem to have a marginal impact on what the equity market tends to do. So it might come as a surprise to some people, but having a split Congress is the best outcome for the stock market. And that's probably because having a divided government will make it hard for any aggressive ideas of one particular side to go through. So having this legislative standstill is actually a good thing for investors. It'll keep those checks and balances in place. And it looks like there's going to be a mix of representatives in government, because the Republicans are pretty much expected to take the House. And even if they don't also take the Senate, there's a Democrat president in place, and the stock market seems to like a split Congress anyway. So according to RBC, if you want the stock market to have the highest chance of getting the best returns, you actually want Democrats to win the Senate, because historically, since 1932, you would be getting a 14% annual return. Remember also that it's going to be 1 year after midterm elections, and the average for that is higher. So basically, things are looking very bullish. Even if you get like a full-on Republican Congress, it's still pretty good at 13%. Much better than the other way around, where you have a Republican president and Democrats in Congress. So the declines we've seen in the stock market this year are normal, but now is the time to be thinking about adding more money to the market instead of selling, because next year in 2023, most likely than not, we're going to see a very strong stock market performance. Be careful not to get in too early and get hurt by the CPI reports, but also don't wait too long, because I think the market is going to front run the Fed, and by the time that interest rates have peaked, most likely in spring or summer of next year, the stock market will have already gone up quite a bit. So those are just some of my thoughts. Let me know if they make sense to you, or maybe you have a different take. In any case, good luck with your investments. Thanks a lot for watching as always, and I'll talk to you in the next one.